Today on The Bottom Line, is the Tesla Model 3 the biggest product launch in history? And new research offers a different perspective on the minimum wage debate. Plus, we talk to the CEO of the largest snack company in the world. Hello, and welcome to The Bottom Line, presented by Fidelity Investments. Henry Blodgett's out of the office this week. I'm Sarah Silverstein, executive editor at Business Insider. Tesla set a new high on June 23rd and has been stumbling quite a bit since then, and this week has been keeping us really busy. On Monday, Elon Musk announced via Twitter that the Model 3 has passed all of the regulatory requirements, and he expects the first one to be completed tomorrow. He says that there should be 30 Model 3s completed by the end of this month, 100 in August, over 1,500 in September, and 20,000 in December. We also got second quarter production data for Tesla earlier this week, which showed fewer deliveries than expected for the Model S and the Model X due to a shortage in batteries, which Musk has said has since been worked out. Despite the recent dip in the stock, Tesla is still up about 50% year to date. If you look at some of the holders for Tesla, one interesting one is the Fidelity OTC fund, which currently has Tesla as its largest holding at 8.5% of its portfolio. It's also one of the largest holders of Tesla stock. And Gavin Baker, the portfolio manager of the OTC fund, he said in January when he drastically increased his allocation, he said that he called the Model 3 announcement the largest consumer product launch ever. And here's a quote from him: "Analogies can be dangerous, but Tesla reminds me of the early days of the iPhone, when Apple had a clearly superior and revolutionary product in a large industry with incumbent original equipment manufacturers just beginning to respond." Analyst recommendations for the stock are pretty split, and given the volatility of the stock, it's not surprising that the range of price targets goes all the way from $155, which is about half of where it is now, all the way up to $464 a share. This week's Bottom Line is the most interesting piece of economic research I've seen recently, which analyzes the minimum wage increase in Seattle. The minimum wage debate is kind of a tricky one, not only just because it's very politicized, but also because we don't actually know what the impact is of raising minimum wage on employers, employees, companies, and the economy. If you look at a survey of economists, of 42 economists that was done a few years ago, and where they were asked whether slowly increasing the minimum wage to $15 an hour by 2020 would result in substantially lower employment rates for low-wage workers, most economists responded that they were uncertain, and the rest were split between agree and disagree. And among those that disagreed, most of them explained that it was because there's no reason to believe it would be substantially lower, even if it was lower. So just to get an idea of something that feels like such a hard science as economics and so number-based, to not really know exactly what the fallout is one way or the other, for me it makes it really fun to read research that tries to tell us the answer. So the city of Seattle commissioned the study and gave the University of Washington access to individual level data, employment data that the city has. And the researchers looked at the move from when Seattle went from $9.47 an hour to up to $11 an hour in 2015, and then the move from $11 to up to $13 an hour at the beginning of 2016. They found very little impact in the first change, partially because it's a smaller move and also because some of the low-wage earners may have already been making more than the $9.47 an hour. But in the second move, they found that the wage increases went up 3% for the low earners, but that the number of hours that they were paid for during that time went down by 9%. The net effect being that on average, each low-wage earner lost $125 per month, or which works out to $100 million in lost payroll in over a year in Seattle. So there has been some pushback to the study. The study doesn't look at companies that have multiple locations, that include places outside of Seattle, which excludes a lot of the big fast food chains. Berkeley did a study of the Seattle minimum wage increase that came out a few days before the Washington study that focused on fast food at all earning levels, and it showed very little impact or very little negative impact from the minimum wage increase. However, as the University of Washington people point out in their research, is that we've done a lot of studies like this before where we look at fast food as an industry, or we look at retail as an industry, and we look at earners at every level, and sometimes you can fire a few low-wage people and hire a management-level person or something like that, so a lot of things get skewed. But the really interesting thing is to have this data point that looks at the individual level data and shows that it may be causing fewer hours for low-wage earners to be getting paid. And it's incredible to me that there's so much to figure out still on this topic, and regardless of whether you think increasing the minimum wage will kill businesses and the economy and just destroy jobs, or if you think that raising minimum wage is the only way to get Americans a living wage, we still need all this information. And this study differs and offers a different perspective and new data and information, which is what makes it so fun and interesting. And it's a piece of the puzzle that we have to incorporate. And that's the bottom line. Earlier, I sat down with the CEO of Mondelez International, Irene Rosenfeld. We talked about some recent news in the grocery and snack industry, and also her experience with some very prominent activist investors. I am here with Irene Rosenfeld, the CEO of Mondelez International, the $26 billion, the largest snacking company in the world. It's a really exciting time to be sitting and talking to you, because with all of the news right now, with Whole Foods being bought by Amazon and Nestle potentially selling its snack division, you're the exact person who I want to know what you're thinking and what does that mean for the industry. So let's start with Whole Foods. Whole Foods has been losing a lot of customers, and people saying, oh, they're going to Kroger's, maybe there's more traditional snacking products there, or maybe they're going to Trader Joe's where there's more private label. What does all that mean to you? And educate me about what it means for the industry.
Over the last couple of years, we've seen a real movement on the part of our consumers to move beyond the traditional supermarket. And so they're shopping in multiple channels. And one of the fastest growing channels is e-commerce. So we certainly are seeing that our consumers are looking to find our products in all different channels. And as a result of that, a couple of years ago, we made a significant investment in e-commerce. We've targeted to have a $1 billion business in that channel by 2020. And the opportunity is just to make sure that our products are available wherever consumers are going to shop. There's no question that Whole Foods integration with Amazon presents an interesting opportunity. I think it will accelerate e-commerce within the food business. I think it will shake things up in the industry. But I would say I think the reaction to the news was a little bit overplayed in terms of the speed and the magnitude of the impact that they will have.
And your e-commerce business, how big is it right now?
Today it's about $350 million. But it is well on its way to becoming $1 billion, as I said, by 2020.
And we all know the products that you guys sell, even if not everyone knows Mondelez that's associated with Oreo and all of the products that we're familiar with. So what's the strategy to break into e-commerce? How do you buy Oreos online?
Well, it's very simply, there's a number of different ways. You can actually buy the product as a single item. You can buy the product as part of your grocery basket. You can buy the product as part of a subscription. And we're finding that we are participating in e-commerce both with our traditional bricks and mortar retail partners like Walmart, like Kroger, as well as with e-tailers like Amazon and like Alibaba. And the opportunity is a little bit different in each of those venues, but the end in mind is for us to have the same strong share position in the e-commerce channel as we have in bricks and mortar today.
Great. And Nestle, we also heard Nestle might be selling off its U.S. candy division. What does that mean to you? Is it because of cost-cutting issues, or is it because they're trying to get more healthy? What does that mean?
I can't speak to their motivation, but what I would say is every time an M&A idea comes along, it causes a lot of conversation about whether or not that predicts a whole new trend for the industry. In our case, we're quite satisfied with the portfolio we have today. We don't need M&A to deliver our growth, and we're very much focused on our strategy of driving growth by accelerating our core products, by continuing to expand into white spaces like chocolate in China, chocolate here in the U.S., and continuing to expand our position in all retail channels, including e-commerce.
And you've had a lot of experience with activist investors and a lot of run-ins with them. Can you tell us from your perspective of a CEO what that experience is like and what, if anything, positive has come out of any of those experiences?
I think a lot of positive things can come out of the experiences, but I think the lessons that I've learned as we have had a number of activists in our stock. I think the first lesson that I've learned is that you need to be your own activist. Before these guys show up, you want to make sure you've looked at your business with a critical eye and you understand what you need to do to unlock value. In our case, we were, as we split the company in 2012, we ran into a real slowdown in the macroeconomy, and so we decided that we needed to pivot and focus a lot more in the short term on margin expansion, which is what we did. So I think understanding what your profile looks like, how you fare competitively is a critical piece. The second is to engage with your shareholders even when you don't have to. We have always had an ongoing relationship with shareholders to listen to what they have to say, to listen to their ideas about what we could be doing better. And I think that's really helpful as you think about how someone on the outside might look at your business. The third piece is to engage. I think there are too many companies that get a phone call and they hang up the phone. I think it is most productive. These guys are smart. And they have interesting ideas, and I think it's really productive to be able to engage with them. But last but not least, the other lesson is make sure you're focusing on both the long term and the short term. Sometimes some of the demands and some of the things they're asking for are very much short term focused, and those of us who are running our companies for the long term need to be concerned about which of those actions will be consistent with where we're going for the long term.
And that's something I wanted to ask you about. How do you balance that? You've been the CEO for quite a while, and most generally when these activists come in or other concerns like that, they are like serving the shareholder, which is important, of course, but how do you balance the long-term investments for the company and the other people for the company, the workers and employees and customers? How do you balance the short-term and long-term?
Well, I think that is the art of thinking about resource allocation. In our case, I really firmly believe that the long-term viability of a company is dependent upon having a balance between top-line and bottom-line growth. And so you need to make sure that you're doing what you have to deliver the bottom line, but you're making the investments necessary to make sure that bottom line is sustainable. And I'm very pleased with the fact that we're one of the few companies who has been able to deliver that balance.
And being on the other side of the activist sort of relationship, is there any advice or anything that you could give to activist investors of something that they usually miss as far as unlocking value from being on your side?
No, I think, as I said earlier, I think there's a number of lessons that I have learned, and I think the single biggest disconnect I have found is that many activists simply sit in conference rooms and do calculations and analyses independent of the reality of the fact that we are dealing with human beings and people's lives, and some of the actions that one might want to take in overhead reduction, for example, can't be executed at the drop of a hat. We have a sizable business, for example, in Europe. And there, one has to consult with works councils before we can make any changes to the overhead population. And so, understanding some of those dynamics, I think, are critical in terms of looking at the feasibility of some of the ideas that any one of us might want to pursue.
And can you talk a little bit about how you feel about President Trump and his role in the economy, or if he's good for business or bad for business?
I think it's a little early to tell. I am hopeful that he will, if he fulfills some of his campaign promises, that it could be good for business. Without a doubt, tax reform is something that would be of great interest to us as a multinational. At the same time, free trade is something that's very important to us, and it would appear that the administration is going in a slightly different direction there. So I think it's a little bit early to tell. We're going to have to watch and see how the rhetoric and the actions come together.
Great. Thank you so much.
My pleasure.
That's it for this week. Thanks so much to Fidelity Investments for making the show possible. See you next week.